like when you look at investment and especially where the investment is going. Throughout the pandemic, there was only one particular relief fund, and it's just because people noticed there was so much finance bias, inequalities within finance, where money was going, that the fund was really set up by the Shine campaign to say, if a fund like this is not set up, a lot of the local companies would just close. So in terms of that financial aspect, this is something that trend's been going on for years. And what we are happy about is that as local businesses, we've always been speaking about it. But now there's data coming from Google, there's data coming from the World Resource Institute showing all of that, and that definitely a change, especially finance, needs to happen. I wasn't surprised. I thought during such a pandemic, we would have had relief grants instead of more equity and debt, because so many companies were getting into debt. They just needed support to push through the sector, because customers need products. You know, in instance of Sierra Leone, where with our population of 7 million people, only 13%, now 26% having access, there's a huge demand. It's also a poor country, but there was not much support for the customers, not much support for the local businesses there. So it was really, really challenging to see that most of the funds that were coming out and support within the sector was either equity or debt, when people, you know, a lot of the businesses were just looking for some sort of cover that can push us through. So I think around the investment side, there definitely needs to be a lot of work, especially as we try to recover better through the pandemic. Thank you.
No, certainly agree. And kind of as shared, luckily there is some positive signs in terms of concentration and going also in terms of deal size. So luckily this is happening, but it's certainly not enough. Yeah, we need to do better as a sector there. Which is a nice segue into Dan. Dan, if you could please introduce yourself and also respond on that first question.
Yeah, sure. My name is Dan Waldron. I'm the head of insights at Acumen. Acumen is a not-for-profit venture fund that we make equity and debt investments into early stage companies that are solving problems of poverty. And we've invested in over 20 companies into the off-grid energy space over the last 15 years, including quite a few in the PAYGo Solar space. We have companies operating in Sierra Leone, Ghana, Kenya, Uganda, and elsewhere throughout sub-Saharan Africa. I think the points that Alex and Mariama have covered were ones I was certainly going to hit, and I could not agree more, particularly with Mariama's point about the places that equity funding is flowing, or that rather that it's not. I agree there's some encouraging signs, but they're long overdue, and I think still the drop-off in equity is concerning, and hopefully we can talk more about that later. In terms of what surprises me, I was just going back to the data last night. The resilience of the sector is still somewhat surprising and encouraging to me. You've seen a drop off in sales, you've seen a drop in repayment rates, but not an implosion, and not even, I had the good luck of penning a piece with Koen Peters right around the beginning of this, who's the head of Google, and we were worried payment rates were going to completely fall to the floor, and that just simply hasn't happened, which I think speaks to the value people see in the products. And yes, I completely agree. There was a need, and still probably is a need, for much more customer support in terms of that. But the resilience that the companies has shown has been really impressive to us as investors. And frankly, I think we would see even greater growth were it not for those supply chain challenges, which have hit a number of our investees. We've seen stockouts across the board, almost in most countries we've invested in. And so as the growth comes back, there's always the counterfactual. We won't know about the gains we would have made during this time, the improvements we would have seen. As the growth comes back, I think you're starting to see the sector transition into more of a broader based consumer finance sector, which finances a range of assets. And so you see those sort of slow down in the very early stage kits. But I think we're not yet seeing, partly because of those supply chain issues, the real rise in more bundled and value-added appliances, and that's what I'll be looking forward and hoping to see over the next coming years.
Oh, for sure. Thanks for that. So then digging into a little bit more the sales. So what we saw is that through the first phase of the pandemic, we did see a bit of a slowdown and also the growth with about 60%. And as Dan also mentioned, we did see that during the first half, it rebounded a little bit, but we're not yet to those earlier growth trajectory. So maybe from your perspective, Mariana, could you share a little bit about what you think were some of the drivers for that slowdown, and whether we could actually see that persist within the coming years, or whether you believe that growth will really bounce back?
Thanks, Rowan. Yes, I do agree with Daniel's point about resilience, and I was going to talk about that because the sector we're working in is such a needed sector. You know, for me, as an example, I was born in Sierra Leone. I grew up there. I've used kerosene. I've studied with kerosene. I've experienced this stuff throughout my life. I've got friends, family members who have. So for me, it's something, regardless how challenging it is, that I know we need to work together to solve, because it's such a crucial issue in the 21st century and where we're living now. So resilience shown not only by myself, but our team members, our customers, engaging with us, trying to see how they can also support us in terms of through focus groups, was quite encouraging, and, you know, kudos to all of them. So I think in terms of challenges, some of the stuff we've experienced from March last year, shipping, which normally took probably a month or two, like our last shipment took five months to get our product, shipped to Sierra Leone, clear from the ports, pay. It was so stressful. Sales, you know, our business is very forward facing. So all our female agents go out, they're speaking. So that affected a lot. We didn't have products in stock. It was really difficult getting products in for us to be selling. And there was still a demand. People still wanted products. And as you can see, there was a lot of connection with the health side of things, and also people, customers needing light. So that was a big push. So for me, I would say products, manufacturers really supported, like some of the manufacturers that we buy our products from, they were really supportive in terms of like how we can do our payments. And I think that was very encouraging. Whilst you had the discussions, they really understood where normally you might have to do an upfront cost. They were willing to say, okay, do a 50%. Once your goods get there and you start selling, you can pay the remaining. So I think that was very encouraging. But our biggest challenge was definitely getting products out there for us to sell, our female agents not being able to go out. And our focus is in rural communities. So we had a lot of operational issues, not selling, not getting products, in cost delays, in salaries, staff, you know, trying to encourage the staff and our operational costs. It was so difficult. I'm just grateful that now in 2021, we're still standing through this support that we got from Shine. I think that really helped us. And then we got some other investment to get products in as well. The ones that I'm talking about that shipped, but the clearing processes, products were being stuck in different places. I remember like when we shipped from Germany, they had to send all the products back, and it was just so difficult. And then they arrive in Sierra Leone and you think, okay, I can clear within a week or so. And it just took months. So that was very challenging. But I suppose now it's getting much more better.
Yeah, thanks for sharing that. And also, yeah, there was also something I enjoyed to see, that the company is also within the sector, and investors were really supporting each other, and you really saw that sense of community as well. So then going from more sales also to the portfolio quality, I think there we see, as also shared before, a bit of a mixed story with some signs of more kind of resilience, but also we did see a bit of a surge in write-offs. So a question to you, Alex, just to understand a little bit what some of the main drivers for that surge was, and perhaps a bit of a increase in risk, and whether you actually see that persisting within the year ahead.
Sure. Yeah, so I mean, I echo, you know, Dan's point. You know, when we were kind of contingency planning at the sort of in March or in February of last year, we ran a range of scenarios. Most of them were much more pessimistic in terms of we were expecting collections to collapse. We were expecting defaults to significantly spike. And yes, they've doubled or they've increased, and as you showed, to 16%. But that is it's an increase which is not great, but it's a lot better than we were fearing. And we've been thinking about, why is that the case? What is, potentially different about the PAYGo sector versus other sectors? Why is it a bit more resilient, even though there's clearly room for improvement? But why is it more resilient? I think the first thing is PAYGo is naturally providing an essential service. We are providing energy, which is clearly important to everyone, irrespective of macro conditions or pandemics. You still need energy to live. So I think we're clearly an essential service. The second thing is, I think the lockout technology that underpins the PAYGo sector has been really helpful, in the sense that our products don't work if payments stop, which is not necessarily the case for other things, where you can stop paying, but the product that you've bought may still work. So I think technology has helped us, and so I think those are some of the things that have been supporting the sector. But why have we seen a spike in defaults? I mean, it's not that surprising, because clearly most of our customers we're dealing with are at the the lower end of the pyramid. They are financially constrained in normal times, and they're just more vulnerable during these times as well. So I think that is to be expected. Initially, it was a case of during lockdowns, we saw in countries like Uganda, where there were severe lockdowns, our customers just couldn't move, and they couldn't continue with their livelihood, so incomes were impacted on that basis. What we do see is, though, going into 2021, on the one hand, customers, their children were not going to school, so they saved a bit of money on school fees. But actually, with school starting up in 2021, that's great, but that does divert, but there's also catch-up schooling, so that's diverted some of their monies. And secondly, we do believe that a lot of the customers have used up some of their savings last year. I think they weren't necessarily expecting the pandemic to last as long as it has. I guess most of us haven't expected this. And so, that's really kind of, it's taking a bit of a toll. And so it's not unexpected. But that said, I don't feel that this is a fundamental shift in terms of performance of the sector. This is a clear, there's clear short-term headwinds due to the pandemic. But as we do grow out of this, I see no reason why performance levels should recover to pre-COVID levels. So I think in the medium to long term, I'm not concerned about that. But if anything, there's still room to improve. But in the near term, this is what we're experiencing.
Yeah. And then going a bit deeper as well, and perhaps also from Marianne's perspective, as Alex also shared, we can probably see that customers will remain to be a bit financially stressed for the coming period. So I was wondering, from your perspective, Marianne, how is that for you? Is it having an impact on kind of the portfolio quality as well? And what some of your strategies are to manage it, and whether you think that perhaps it would be good if more supply side and demand side subsidies would actually come in to help the sector manage this as well.
Yeah, thank you. Since the start of Smiling for Life, I think one of our USP in terms of our community engagement has been storytelling. So we work with local storytellers in Sierra Leone, and we've developed stories. For example, we have stories where we describe how a firefly works, but in the terms of solar products, because in the rural communities we're working with after the war, the literacy levels there are really, really high. So it's really thinking local context, how do the communities that we work with understand the things that we're doing? So storytelling is quite big for us. So even during this pandemic, that's what we've been doing, using different stories around the pandemic to speak to our customers. We do a lot of skits. So in Sierra Leone, they have big market days where we've worked with local comedians. They do skits, they go into the market here, they speak to people, we do them outside our shops that we have. And one thing for us, we also have regular focus group discussions. So before, our products were all cash sales, and during the pandemic, we now started moving into PAYGo, which was really led by our customers. So now we're offering both cash and PAYGo for customers that can't pass our credit rating system, which has been really, really exciting. So regular focus group discussions, we phone our customers on a regular basis. I was in Sierra Leone this year from January to May. So I had an opportunity to go and see most of them, to speak to them, to find out what's been their challenges as well, because sometimes it's very important, not only as a business, to understand from our perspective, it's also interesting to learn from customers themselves. Where in Sierra Leone, where an area where one of our shops are, for example, in Lonsau, that's a mining area. So we've always had really good sales there, because it's very busy, it's business, compared to, say, Kamakwe, where there they do a lot of timber, but it's very much young people. So in our sales, it would always be different. So understanding what's been their constraints has been really interesting and important for us. As we all know, the pandemic hit a lot of the African countries. So governments' thoughts, plans really changed and focused on the pandemic, which was really interesting. So I definitely do think now for lots of the rural communities, some subsidies or any type of support for them, it's really, really needed, because people still need light, people still need energy, people still need the energy to so any government support or subsidy would be needed. I think in the sector, a lot of the focus has been for business sustainability, supporting businesses, but not a lot towards customers and how they're feeling, how within a household, you're probably moving, some of their school kids were not going to school, so probably that saving, having to reinvest it back to, say, getting a product. But now when they want to go back to school, what happens? So I think some thought and consideration needs to be for customers, but most of our work that we do has actually been designed based on customers' experiences, based on the work that we're doing, and based on their knowledge and expertise from the ground, and basically informing us to develop certain policies that would address their needs.
Yeah, thanks for sharing that. And indeed, kind of the business consumer interaction and constant interaction is really important to be able to get insights in how they're doing and what the business could potentially do differently to service them. So maybe one last question more in terms of the impact on either the COVID pandemic or different factors. We of course see currently that there is a bit of a shortage of chips, of our electrical components for the sector to actually construct to manufacture their products. And this is also leading to some increased prices of raw materials as well, which could potentially be transferred to the customer. And I just was curious to hear from you, Alexander, what the impact has been of the shortage of electrical components for Azure and how you're dealing with it at the moment.
Yeah, no, it's been a bit of a roller coaster dealing with our inventory management over the last 18 months, and kind of to Mariama's point earlier. Initially, it was when the pandemic started, factories were being closed temporarily because of local lockdowns, and that delayed production, or it was very sort of ad hoc. And so that disrupted supply chains a little bit. Then shipping lanes were taken over by medicine transport, etc. So sometimes it was hard to get on a boat. Then you get into Mombasa, and the offices are closed because government offices are closed because of lockdown. So it was just very hard to get everything cleared. And so we kind of saw that and thought, okay, this is a bit painful to work through, but we can kind of put in bigger buffers to work around that. But I think what's happened is a lot of the downstream or upstream factories then actually took the decision to reduce capacity, and just thinking that there was no demand, but demand, as you said, has recovered from mobile phones, from electric vehicles, from ourselves, etc. And so now it's been a case of there are shortages of chips, particularly lead times have increased. So it's been quite challenging. So the way we've really tried to go about it is we've been forward purchasing more than normal in terms of critical components where possible. That's one thing, and so we've been doing that. Certain components we've had to pay more for, unfortunately. So the prices have increased by 10 to 15% on certain components, whereas we were expecting them to decrease. So that's something we've been working through. And I guess the third point is that we have been actually redesigning our products to the extent possible to accommodate alternate chipsets. So whereas on the one hand, our products were designed to accommodate chipset A, and if chipset A is no longer readily available, we've been looking at chipset B and C and saying, okay, is there anything, could we accommodate that other chipset, and redesigning the products, making small changes to the design to accommodate these different components. And that's how we've managed to at least try and sidestep some of these issues. But no doubt about it, it's been challenging, and we've been working closely with the product team to try to navigate all these things to ensure that our supply chain keeps moving.
Yeah, indeed. I think many of our members at Google as well are really struggling with this. But it's great to see that there's some innovation happening, and yeah, trying ways to circumvent it. And then, Dan, I'd like to ask you also, we've seen as well some of our members as well diversifying their product offerings, perhaps due to electrical shortage components, but also through the COVID pandemic to service their customers better or in a different way. We've also seen more productive use coming in, or perhaps companies offering smartphones as a bit of a side stream of business. So as an investor, have you also seen this in the space? And yeah, do you believe that the diversification helped companies as well throughout this COVID pandemic?
Yeah, I mean, to me, this remains one of the most interesting, if not the most interesting thing about the PAYGo sector, is that really it began as an energy access sort of play and really is consumer finance at the end of the day, although the different companies, I think, position themselves differently within that. And for our companies, absolutely. We've seen D-Lite, who we've invested in since 2007, become one of the largest smartphone distributors and financiers in East Africa. And that's incredibly exciting. And smartphones bring connectivity, they bring access, financial services, financial inclusion. In West Africa, we've seen PEG grow into becoming a financier, not just of solar home systems, but in addition, solar water pumps, large home systems, power systems that can really run a business. And we see companies experimenting with assets such as electric pressure cookers and even larger productive use assets like maize grinders and different experimentation there. This is early days, so whether or not it has helped diversify and helped people be resilient to COVID, I think is a little bit tough to say at this point, frankly. I do believe that long-term that will be the reality of it, that as you diversify assets and frankly diversify then your customer segments, that brings strength to the company, exposes them to different regions and different markets within those countries, and makes them more resilient to the shocks that will come. Obviously, then the question a little bit is one of mission drift. And so when does this become a good strategy, and when does it potentially move companies towards higher value, higher margin products and segments, and away from the initial vision of energy access? And so that's something where we remain quite focused on. Our role sitting on boards, observing on boards, is making sure we think this is an incredible development. It is absolutely the future of PAYGo, but also making sure that the focus remains still on serving those customers in those communities that Mariama's spoken so well about. And so that's the mix that needs to happen. And I think if done well, it can lead to a much stronger, much more resilient sector. I think we're still kind of early on in that journey, although in some places like smartphones, we're seeing, I mean, certainly in the hundreds of thousands, if not more than that, of PAYGo, finance smartphones being dispersed and generated over the last couple of years.
Sorry, I was muted. Indeed, well said. Indeed, around kind of the tensions between, servicing the hardest to reach customers and really trying to make sure that we reach SDG 7 while also remaining a financially sustainable business. And while I have you, I just wanted to also talk a little bit around some of the investment trends. So what we see is that there's still quite a robust flow of investment coming into the space. We also see that the current investors are quite loyal and they keep on investing. And in terms of liquidity perspective, we do see that it is holding up fairly well. Yet there are still some reasons for concern, and not a lot of what we also touched upon in the beginning, not a lot of equity coming in the space and perhaps new capital into the space. So from your perspective, what do you think is needed? What type of capital or what kind of players in the coming years?
Many types. The loyal investors, I think, is a good phrase to use. I agree. We've seen the same thing. There's incredible investors in this sector who have really helped to build it. Investors like Persistent Energy, Venture Builder, others. But loyal is also, I think, a good euphemism for we're not seeing quite as many new faces as we would like to see. Not enough new equity investors coming in, particularly coming into the sector in the last few years. And I think those numbers reflect that. There is a whole crop of exciting, dynamic new companies coming up in all sorts of different markets across Africa and elsewhere. And they, at least anecdotally, the ones I speak to, and maybe Mariama could comment on this, are struggling to raise equity in the same way that initial players were. And that's not because we've solved the problem of off-grid energy access universally across sub-Saharan Africa. In some cases, it's because existing equity investors have struggled to exit to more commercial investors, have struggled to sell our shares. Sometimes you see impact investors who want to make investments but don't want to purchase existing shares. They want to make new equity investments. We see the reasoning behind that, but frankly, then you have this problem where you hollow out the early stage going forward for the next generation. And it troubles me, frankly, when we see big global initiatives like the Global Energy Alliance just launched by Rockefeller that doesn't have the money for the early stage off-grid solar investments that we would like to see. I think there's an increasing sense that this sector has sort of been figured out and it's a solved problem. And I couldn't disagree more. There's a need for tremendous amount of new investments in new companies, as well as investment to enable existing companies to go into harder to reach markets like you just talked about. And whether that's through subsidies or whether that's through sort of more creative products, Acumen is looking to launch a series of impact index debt facilities that will enable companies to serve harder to reach countries or harder to reach segments within countries. That's what we need to start taking the sector that we know fundamentally works, but making it work for everyone. That's going to require blended capital. It's going to require some innovative and risk-taking capital. And that's what we see, that's what the slowdown in equity really worries me about. Is PAYGo going to work for everybody? And it's not without a little bit more risk-taking and a little bit more innovation, particularly on that early stage equity piece, but there's obviously other parts to it as well.
And what's your take on more going beyond kind of the concessional financing in terms of the demand side and supply side subsidies? Do you feel that overall, or perhaps in particular markets, that's very much needed to somehow also reach those hardest to reach customers, or perhaps to really kickstart some of the sectors there?
The short answer is yes. I mean, I think it definitely does depend on the market and the segment, but you saw in COVID the benefits of providing customer relief, which is a different form of demand side subsidy. I agree with Mariama, we would have loved to see a lot more. I mean, we saw with one of our investees, D-Light, the Shell Foundation was able to step in and give them a grant, and they were able to provide free PAYGo access for, during a couple of months last year, during sort of the height of the pandemic, or what we thought was the height of it at the time. Going forward, I mean, PAYGo has an interesting problem too, in that it's very difficult to offer customer relief. We saw utilities around the world just leave the lights on even when customers couldn't pay, and we saw microfinance institutions defer loan repayments. PAYGo kind of needs to do both, and so that's been a worry for companies that if they let people use the products without paying, they wouldn't resume paying later. However, I think you're seeing the evidence that that's not the case. I mean, we heard from a colleague of ours at Phoenix International, where she was telling us they had a quite positive experience giving customers relief, who then resumed paying because they were super clear and communicated it quite well to customers that the relief was time limited. They began paying again once the grant had been phased out. So I think there's a space for that, but more importantly, I think there's a huge role for governments to play in de-risking demand side subsidies, yes, where it's possible. The technical realities of that remain quite complicated. And so I think the realities we're going to see a lot more supply side subsidies and a lot more results-based financing. And frankly, if that's what it takes, that's great. If that's the second best solution, that's what we can make work. That's what we need to, because without that, harder to reach areas, poor customers are going to remain, if not non-viable, just on the edge of financial viability. And so I think it's important to keep the impact focus there.
Yeah. And then before I go into the next question, I just want to make sure for the audience, please do submit any questions that you have. I'm happy to put them in there as well. But if not, then I'll just continue with some of the questions that I have here. Maybe from either Mariana's or Alexander's perspective, just hearing a little bit about how you currently experience the investment landscape for you as a company. And perhaps with that, we can start with Mariama and then go to Alexander.
I think for me, it's really, really challenging. I think since working in the sector, we've seen money coming in, but it's like where the money is going. So even Smiling Through Light in the start of next year, we're going to hold a finance event entitled Clean Energy like Access. Where's the finance actually going? Because with companies like ourselves, we're not looking for big investments. So for example, our growth plan and everything we have for this year is about between 200,000 to 250. So we're kind of stuck in that position where we've had start-off capital, and we're now in this middle section where we're just trying to grow and there's no money flowing there. But if you were looking for investment of say 500 and above, that's available. So much more work needs to be done within that middle section. And I know people like Charm Impact have come into the space. They're trying to support smaller businesses to grow within that area. But I definitely do think for like women-led businesses, there's not a lot of finance going into that sector. So for us, we're dealing with two types of challenge, where it's like a local business where finance is not going, and also it's women-led. So 80% of our team, we're all women from the founder down, and even on our board. So much more work needs to be there. And I just feel with what SDG 7 is about, where you're not leaving anyone behind, currently within finance, I think a lot of the sector, predominantly in Africa with local businesses, we have been left behind. Like I mentioned before, in terms of like the finance bias, where the money's going, it's more, for me, it's looking at kind of local connections within networks, the people So most of the people the companies that I see in Sierra Leone, who are international companies, they would know all the investors. They probably meet in the same place, they network together, so they know what's happening. And it's not a space that for someone like me, it's easy to access and enter into. And I sometimes feel like, even though I grew up in London, I've been here since I was 9, I work here and in Sierra Leone, I always think about like a local entrepreneur who is like based in Africa, I'm having these challenges. So I wonder how challenging it would be for them to kind of access and finance. So I think there does definitely need to be some sort of inclusiveness within the sector. I think that investors also need to play a role in engaging entrepreneurs like ourselves. The Global Distributors Collective recently, they released a report to say smaller local businesses, they're not looking for a lot of finance. We're quite lean in our businesses. Our monthly burn rate is not that much. Like for us at Smiling Through Light, it's about $1,000 a month to run all our team, all our operations. Our rent is very low. So why is support there? But money is going into the bigger organizations where they need much more capital. And you know, it's just much more work. So we do that sector, or I don't think no one can achieve the SDG 7 if you don't have that local knowledge and local expertise. We see the sector creating jobs. We see what the sector is doing in terms of support. But I definitely do think financially, as we're moving forward, we have to address that elephant in the room to know there is a lot of bias within the sectors, and that investors definitely need to start using different strategies of where they try to understand. And we also want to understand from their perspective, like, why aren't you investing in, you know, in local businesses? What is it? Is it your business plan? Is it your growth plan? What can we improve? And I think some time needs to be taken aside to do that. Or I've been in the sector 10 years. In the next 10 years, we're still going to be having the conversation. But the good thing is that we are having the conversation, which is always a good start.
And I certainly hope that in 10 years, we won't be having this conversation anymore. And that in the coming years, we do try to find a solution for this. And especially, I agree with you kind of around that the connection, right? And having that network actually to reach out to the investors. And as a lot of the capital is still coming from Europe or America. And it's about creating that connection, which is even harder these days with COVID and having all these online events. But hopefully we can make a change there altogether. And then from your Alexander, do you agree with Mariana? What's your sense of the investment landscape at the moment?
No, absolutely. I agree with you know, Mariana's last point as well, in terms of you know, talking to investors. And you know, there's definitely, you know, the investors have come more cautious, you know, as you would expect during these times. And we've been going back to potential investors, both debt and equity, and asking them, you know, what is it that really concerns you about in general, or about COVID, et cetera, and really trying to delve into that and try and resolve some of those questions. I think even, you know, coming into the pandemic, a lot of investors were focused on paths to profitability. You know, how long is it going to take for you to get there? And we've also taken the opportunity to, you know, given, you know, we're in a period of slower sales, you know, now is a good time to really start, you know, optimizing the business, relook at processes and improve them. So not just, you know, go back to where we were pre-pandemic, but actually build back better, you know, for lack of a better phrase. So I think, you know, we've been really focused on that, and I think, you know, that's it's useful to do that. The second thing is we've been diversifying our our access to capital. So we work with a wide range of lenders. So initially, I think we all worked with development finance institutions, which has been incredibly helpful. We've since been working with, you know, dedicated impact funds, but also, you know, getting the retail investors actively involved by participating in various crowdfunding platforms, you know, globally. So I think, you know, to Mariama's point, it is challenging to access capital, so we've taken the approach that we need a really diversified diversified sources. And what you've seen during, you know, the last 18 months, some, you know, one source may be pulled back a little bit, another one becomes a bit more in line, and so that's kind of how we've been navigating the volatility.
And what you mentioned there also around kind of rebuilding back better and trying to look at the company and perhaps improve certain processes or things like that. I'm just wondering from your perspective, going forward, what do you think is the main opportunities or perhaps main ingredients for growth for the OJS sector?
Well, I think, I think, you know, Dan covered it quite well in terms of initially this was, you know, just about financing, you know, solar assets in particular, but the reality, it is a consumer finance business, but it's asset backed. So I think, you know, one of the, you know, the big changes with PAYGo is that you're financing a very specific asset at the time of, you know, taking out the loan. And I think we do think this is the future of a lot of financing in Africa, because by restricting, what exactly you can do with a loan to an asset which investors deem useful or customers deem useful, you have a better sense of how money will be used. And so I think, we're starting off obviously with energy access. A lot of people have been working with smartphones, and that is a huge development for the sector. Solar irrigation, and lots of other sort of productive use. So I think the sector, has opportunities to diversify itself, but at the same time, there's still plenty of work to do just in terms of basic energy access. And my sense is that we absolutely need to not forget about that, and make sure we're not leaving anyone behind. We are going to these more difficult, rather than sticking to the easy markets and just building up more expensive product. I think we've got to be careful with that, and so I think that is key, and it will be important for not only investors to support us in that, but also the companies to recognize that we do need to focus on operational excellence, etc., to continue to get the support of investors.
Yeah, very well said. Dan, would you have any other thoughts kind of related to that?
Yes. I hope I will phrase this the way I mean to, which is just to say that one of the things that has troubled me and troubled our team a little bit over the last year or so is that as companies struggled with all the things we've already talked about, right? Supply chain issues, equity investors pulling out of verbally agreed upon deals, all the fun stuff. The value of the impact that companies create was not as fully appreciated as some other impact investors as we hoped it would be. And I'm speaking quite vaguely because I have to, but we see companies with really strong core operational metrics that are running good businesses that were hit by a pandemic, the externalities of which I don't think they should reasonably have been expected to be ready for. And when it came time to put up additional capital and keep these companies running until they could raise again, not everybody was quite as ready to do so as we would have expected, sort of ex ante. And there are different reasons for that. But at Acumen, a core part of the return we get from our investments is the impact that is created by companies like, we're not invested in Azure or Smiling Through Life, but still by companies like in this sector. And that needs to be valued, and the impact needs to be valued by other investors. And so that was troubling for us. I think everyone sort of as some more have come around to this, but we thought generally speaking, the response, especially from big public institutions, could be stronger in terms of supporting the sector. It's gotten there, but it's taken a long time. And so I think when the next time comes around, figuring out how we value that is a key part of how we then respond and keep companies going that are creating really impressive change and solving really difficult problems.
Yeah, and it's really also about going, as Leslie also stated it before, going from de-risking investment to also valuing the impact that it creates and looking at investments differently. So I think that will be very, very important for the years ahead. I actually see that we're running almost against time. So I'd like to also give this question to Mariana, then to see a little bit, how do you see the future going ahead? What are for you your opportunities for growth? And then afterwards we will close off.
Yeah, we're optimists. We've always been. I think we're all working in great sectors. I think everyone, companies, government, everyone brings in their own skill because we're all working towards one big goal, which is a great thing. So for me, going forward, it's always exciting to see what new changes are going to be. In terms of Smiling Through Life, we're going to keep on our own vision, where it's clearly about, empowerment of women, creating local jobs, and growing our sector. And also just the work that we do in Sierra Leone, changing that kind of narrative of the country. I think it's also important for Sierra Leoneans and what the country is to see how far we've come since, like, you know, we started working, or since the Energy Compact Agreement has been signed. So for us, it's a good thing, and there's good sign where now the government plays a much more active role. We have a Renewable Energy Association of Sierra Leone, where Sierra Leoneans are making decisions and pushing things forward. So we've definitely seen progress. There are policies. What needs to now happen is the action to deliver on a lot of things. And as we all heard in COP, you know, most of it has to do with the finance and making sure we grow and get that money, but ensuring that it goes into the right places. So we've been on a steady kind of path, first selling smaller products. Now we're moving into the PAYGo sector. We're going to work there. We're going to learn. We're going to, you know, our business models change slightly. We want to invest in, you know, work around that for the next year or two. We see ourselves as small fishes. We're not trying to rush, but we're trying to work accordingly to what we can and accordingly to our capacity as well, and accordingly to the support that we have. So as a team, when we speak to the team, as challenging and as difficult as it has been, we clearly see the vision. We know the vision's there, not only for Sierra Leone, but throughout Sub-Saharan Africa. And that's what our ultimate goal is, and ensuring that we focus on that and work on that. Within the couple of years, it would definitely change to say, you know, working with farmers, you know, in terms of like solar water pumps. But now, as Alex was saying, the key is energy access. That's why the business was set up. So we need to focus on that and achieve our ultimate goal.
And exactly, and I think yeah, for the years ahead, we certainly do have our work cut out, focusing on energy access and seeing this also as perhaps an enabler as well. So maybe to summarize as well the session, I think overall what we see is that it's been a tough year for us all. It's been a challenging year with not only COVID pandemic, but also different changing macro economic factors as well, with the pressure on kind of the supply chain and the shortage of electrical components. But overall, the business model and also PAYGo and the off-grid solar sector has shown some resiliencies, has also shown ways to innovate and also to look for each other in these times that are difficult. And the potential is there. We have about 588 million people that are still not connected to the grid. Another 152 million people have to also put up with unreliable grids in Sub-Saharan Africa. So really that focus as well should be for us to enhance that energy access. And yeah, it remains also the cheapest option to also electrify them in the sector. So with that, I'd actually like to thank you all for being at the session today. I definitely enjoyed the conversation, and wishing you yeah, a good rest of your day.